Hey everyone, Dave Lewis here with High Impact CPA. Hey, I'm chilling on the beach right now. I mean, at least metaphorically. I wish I was literally there. Nope, still in the office at home. Yesterday was the extended deadline for pass-through entities, so partnerships and S corporations. Just got through that, doing a good debrief with everyone today. And I thought since I'm relaxing in t-shirt mode, ditched the blazer for today. Might as well go through a few of the things that I saw again this tax season that are worth mentioning. Now, when new clients come to us, there's typically a couple combinations of these things happening that are making it very difficult for them to either A, run their business or B, get the most tax savings they possibly can. And what we do is we go in first off and correct this, right? So we build that foundation to make sure that we can actually go into the cooler stuff like tax planning, CFO services, growing your profitability and cash flow. It's the main takeaway once again for this year, and I'm sure it will be perpetual moving forward, is with new clients when they come to us, there's typically a few systematic things that are missing, and potentially some bad advice they've gotten in the past or haven't gotten any advice in the past that we've been seeing. So, I mean, first one is almost always mixing personal and business money. Um, when you're starting out as a business owner, this is really, really easy to do because I don't think you necessarily may understand the risks that are involved with it. And you're moving so quickly that it becomes sort of an afterthought in everyone's mind. But um, mixing your personal and your business accounts, one, it makes the accounting really, really messy. Makes it very difficult for you as a business owner to actually look at your numbers and make some decisions that are going to lead to something that's actionable and will move the needle forward for you and your business. It's very difficult for us as tax professionals, if you're a CPA that's just a tax professional, to look at that and say, okay, I can put together a coherent tax return out of that. It always requires some level of cleanup. Now, at least the way that I've structured this firm is we do both. So we do both accounting services and tax services and like to combine those together so this doesn't become a problem at the end of the year. That um, just be careful with mixing the personal and the business expenses. Once again, you're putting your corporate veil at risk. So last thing you want is your personal assets to be at risk in the event that your business ever gets sued or something like that. But I'll leave that for the attorneys to talk about a little bit more. From an accounting standpoint and a tax standpoint, it can be a nightmare trying to unravel all of that when we're talking about going back 12 months to fix the problem. Um, Other thing we keep noticing is underpaying and ignoring estimated taxes or payroll tax compliance. I mean, it hurts because there's interest and penalties that are easily avoidable with that, especially on the payroll tax side, that those can really hurt. So, um, again, making sure that your systems are in place to mitigate those risks and be in compliance that's part of that baseline foundation that you should have. Other thing I'm seeing is people not really understanding the difference between a tax election, a tax type entity, and a legal entity. So we'll get the question all the time, hey, should I be in an LLC or an S corp? Well, it's a mix of both. An LLC is a legal entity or a limited liability company, right? And an S corporation is an election you make under the tax code to essentially be taxed slightly differently as a pass-through entity. And there's a lot of, I think, misinformation out there around, S corp is the gold standard, and it's true that most business owners will benefit from that structure, but it's still worth looking at based on your goals and your particular circumstances. So, for instance, if you're starting a tech company and you're wanting to get a ton of seed funding, you want investor money, it's maybe behoove you to be a C corp where it's its own corporate tax entity. You can have unlimited number of investors, unlimited types of investors, and you can really bring the money in quickly. Any public company you have is going to be a C corp. Um, S corp's good for its own thing. And partnerships can be good for other situations. And sometimes you've got more complex structures, like a partnership up top that allows you a little bit more flexibility in distributions, and other owners have their own S corps. It really depends on your own situation. And following the one size fits all approach typically isn't going to be your best bet. Other thing that I'll see, speaking of S corps, is understanding reasonable compensation. So, um, making sure that you are actually creating a reasonable compensation amount where you're paying yourself a salary, you're paying your payroll taxes, you're submitting your 941s on time, things like that, and then worrying about the distributions that are free of those self-employment taxes. So, is other things I'm seeing, weak substantiation, so meals, auto deductions, home office, capitalization versus expense policies, um, not having good record keeping for all of those things, and good policies, could lead to disallowed deductions. Just could cause more issues in an audit than they otherwise need to be. The good news is these are low-hanging fruits. These are easy things to put in place that any business owner can benefit from. And there's a bunch of other things. I think I'll leave it at that. I think I've rambled on long enough. I'm going to go chill out, be down in St. George next week, having a good old time. But I will keep everyone updated on everything. We've got more content coming. So thanks, everyone. Take care.